Hey, welcome traders. This is Kurt Frankenberg from Colorado Springs, Colorado, and RadioActiveTrading.com. And I made a promise yesterday that I was going to show a riskless trade that could be done to pull some money out of a married put position without necessarily ever having to pay it back. And still leave your upside unlimited. It's part of a claim that I made yesterday while we were on a webinar, and I said that I was going to make a video about it, so here it is. Just before I show you that video, I want to take you around back of the Radioactive Trading site. Up here where it says RadioActiveTrading.com, if you plug in EOY, end of year, EOY, you'll see an offer that's going to be up there for, I guess about the next 30 hours or so. Okay,
Hey
we're
there,
taking
traders.
this down.
This is Kurt Frankenberg.
I'm yammering. Let me take
Hey,
that
I'm
off.
the fellow that you've been listening to on our free.
I don't know if you guys can hear that, but I was yapping at you. So anyway, this is December 29th, 2012. At midnight on December 31st, the offer goes away. So, EOY, radioactivetrain.com/EOY. Okay, now we're going to go to Power Options, powerop.com/RAT for radioactive trading. Okay, and Power Options is the software that I use. I was customers of these guys before we partnered up about 5 years ago. And they are who I use in order to evaluate my positions. We're going to look at, they've got all kinds of different strategies that you can search on. Not all of them are shown here. These are just my favorites. And then, of course, the married put strategy is retooled and revamped to reflect the radioactive trading style, because everything in radioactive trading begins with a married put, and a married put done a specific way. Well, let's go over to the custom spreads because we're going to go beyond a married put today. And I'm going to use an example that was sent in yesterday at our webinar, last webinar of the year. One of our clients was on the line, and he had he had texted in to brag, and he should be bragging because he did very well here. He was bragging that his DDD position is bulletproof. Now, I'm not sure how he arrived at this cost basis because what we teach here is that you buy stock and you also buy a put option, and then you use one or a combination of 11 different income methods to then begin to reduce the cost basis. Okay, but his cost basis on the stock was $41.50. I don't know if he did that by buying it at a separate time, or if he did that by using one or more of the income methods. He just basically wrote in saying, "Hey, my cost basis now is $41.50 for the stock, $4.50 for the February $50 put option." And this is what that looks like. This is a bulletproof married put. Okay, bulletproof means that the strike price of that put option is higher than the net cost basis for both the stock and the put. And you can't do that at the same time. You can't go out and buy a stock, buy a put, and it's already bulletproof. Okay, you're going to have to use one or more of the income methods, or you might stagger one purchase or the other. Okay, either you buy the put at a different time or buy the stock at a different time. But generally speaking, it's by way of the income methods. Now, here we have a risk of negative $400. That means that out of the capital that our client has put into this trade so far, he still has an unlimited upside. If DDD continues upwards, which it did yesterday, it continued to go up yesterday. If it continues to go upwards, he's got no limit to how much he could make. But if DDD crashes, what do we see absent from this graph? There's no break-even line. You see, the worst that he could do is he could take in the $400, regardless of where the stock's price ends up by February. Now, this isn't the income method. This is just the present status of our client stock. I said, hey, I'm not a broker, but I could point out that the income method that's very appropriate to this trade here, or one of three that are very appropriate. We've got 11 different income methods, and there's three that are very appropriate for him to take out some money right now. I'm just going to show one of them. I'm going to show income method number 6, which is doing a bear call spread. If you don't know what that is, a bear call spread is where you sell a a lower strike call and you buy an upper strike call and you end up with a credit. So we're going to sell one of those and we're going to buy one of those. Now watch what happens. When I press submit, the Power Options platform grabs the natural bid and ask. I may be able to get a better price. I may be able to get a better price than the bid of $285. I might be able to get $290. And I might be able to get this call for less. Instead of $1.10, I might be able to get it for $1.05. All right, but in this case, we've collected $1.75. Now, do you remember what the risk was before in our client's trade? It had been $400, negative $400, meaning that he was guaranteed $400 no matter what happens. Well, now we've just added that 175 of the bear call spread. We've added 175. That's the worst case scenario. Worst case scenario is the stock crashes. If it crashes, we still keep the 175 and we also still keep the 400 that we locked in. But if you'll notice, we've still got an unlimited upside. Unlimited upside potential because we didn't cap off the earnings potential by using a covered call or some other nonsense like that, naked put. We used a bear call spread in the context of our married put. Pretty cool. Now, if we had just done the bear call spread, we'd still pick up $175, right? But there would be risk that would be attached to that. The risk that would be attached to that is, hey, if the stock goes up, we end up on the hook for $5. That whole $5 spread from we have to deliver the stock at 50 and we have to buy it at 55 if the stock is higher than 55. Okay, and so that means a $5 payback of that 175 that we pulled in. Well, wait a sec. That means that we're in the hole by $325. We lose $125. This is how most people play spreads, believe it or not. They actually open themselves up to risk. I don't like to do that. This bear call spread can pull in $175. But if you do it in the context of a ownership of stock, you don't have any risk to your capital. And that is income method number 6. I hope you enjoyed it. It's just one of several ways to pull some money out of a stock and options position without limiting your upside and without necessarily selling right now. Okay, I'm Kurt Frankenberg with RadioActive Trading. Remember to go back to this page here. Oops, I guess I better plug her in. RadioActiveTrading.com/EOY end of year offer. Because we've got some bonuses that are offered along with a very fair and very reasonable price and a money back guarantee. This is truly a bulletproof trade in and of itself. All right, traders, we'll see you out there. Happy trading and bye for now.